Hi everyone and welcome to Investing by the Books, a podcast by Redeye. I'm your host Eddie Palmgren, and in the Zoom call here is my friend and colleague Niklas. How are you?
I'm good. We're approaching vacation time and I will go to Greece for a couple of weeks. So looking forward to that, to have some time to think and reflect of everything we have done for the last year. And today we have the great pleasure of speaking to Magnus Angenfelt. Magnus is a longtime friend of Investing by the Books and the author of The 99 Greatest Investors that we will talk about today. He let us publish each chapter as a blog post earlier on investingbythebooks.com. So we actually have most of the book published there that you can check out. And Magnus has a long history in the financial industry as a top-ranked sell-side analyst and a hedge fund manager. He managed Manticore Capital, a TMT hedge fund, from March 2000 to December 2011. And we believe there are many lessons to be learned from Magnus's experiences. But Eddie, why have we chosen this title?
Yeah, some of the reasons are what you mentioned. Magnus has a really long experience. And also we have several times in the podcast mentioned Isaac Newton's concept of standing on the shoulders of giants. And I think this book is truly a great example of learning from the best. And for less experienced investors, the 99 investors, it's really a superb collection to start with. And there are many names that people probably haven't heard about. And also for sophisticated investors, I think there should be at least one or two new persons and sources of inspiration here, which easily makes the book worth its price.
And how is the structure of the book?
Yeah, the pocket version that I have is from 2013, and this book is a bit more than 300 pages. So it's about 2 to 3 pages about each investor. And first there is some advice from the investor, and that is something that Magnus has been in contact with the person to actually gain those words from. And then there's a brief background about their info, career and investment style. And he also adds some fun facts like Jim Simmons. He's often showing up to formal business meetings without socks. I don't know how he found out all that information, but it's a bit fun to have that as well. But how does it relate to Redeye's quality rating?
Since these are the greatest, the legends, much of their investment knowledge is incorporated and refined in our quality rating. For example, already in the first person of the book, the Japanese investor Shohei Abe, we can see the connection. So Abe explains the 3 key things he looks for in a company, which are different aspects of people, business, and financials, which are the 3 pillars of our rating system.
We are curious and excited to have the author of The 99 Greatest Investors on the show. Here comes our conversation, Magnus Angenfelt. Hello, Magnus, and welcome to Investing by the Books podcast.
Thank you very much.
Where are you today?
I'm sitting at home. Friday, it's a bumpy market, so I need to have some kind of coverage in my fund.
And where is home for you?
Home, it's Lidingö. It's an island outside Stockholm.
Perfect. Can you tell our listeners a bit about yourself?
Okay. I started off as a business journalist in the mid-80s, and then I became a stock market analyst at Alfred Berg. It's an investment bank in Stockholm. My boss, after a while, left and started Brummer & Partners. That was the first hedge fund group in Scandinavia. And I joined a couple of years later, and at Brummer & Partners, I started with a couple of colleagues, a hedge fund called Manticore. And I spent 11 years there and left to write a book, The 99 Best Investors in the World. I got some abstinence after that, so I have started a new hedge fund again. It's called Chelonia, and that's the name for turtle in Greek.
Ah, interesting. We'll get into your current experiences and your past a bit later. But first, how did your passion for investing start?
The investors in the book, they claiming they were very early been interested in the stock market. I think Daniel Loeb mentioned that he was at the age of 5, he started to look at stocks, and I have my doubt about that young age. But For me, it came a bit later. I was mainly interested by the corporations. So I started first in the mid-20s, and then I was stuck.
And as you said, you created a book about the world's greatest investors. And what is clear is, how the different investors differ in methods to achieve the greatness. And we can begin with why you decided to leave the fund and write the book.
It started with curiosity, because we did quite well at Manticore, which was the name of the hedge fund. I have hardworking colleagues, and we were nominated as one of the best hedge funds in Europe several times. I was sitting in my tuxedo at the ceremony, but we didn't got the trophy. And I just wonder what have the other guys done? So I started to communicate with some of the good performing investors and about strategies, etc. And realized after a while that this must be very interesting to more than me to read about. So then I thought that maybe if I could spot the 100 best investors in the world and ask them to share the best advice to the next generation investors, that would be the ultimate investment book. So that was the start, and then that would also bring some good to the world, in fact, because most of the investors, private investors, making losses, and that's the same all over the world, unfortunately. Despite what they say to you at the party or as a neighbor, they're making losses. And one anecdotal story is Peter Lynch. He was managed Magellan Fund in I think it was 13 years and made some 29% yearly in performance. Amazing track record. And when he quit, he tried to get a sense for what the average client had made in profit from his fund, and realized that to his surprise that the majority of clients was in red. They have sold at the bottom and bought at the top several times. And if they could have some good advice of this book, maybe it could be some better performance in the future. And that's also bringing good to our welfare, because as it works, if your neighbors rattles about a good investment, you should give him a warm hug, because on the margin, he has increased your welfare. That's how it works. And then it was also another element why I wrote the book, because it's a lot of focus on entrepreneurs in the society and the media, and investors are mainly not mainly but not so seldom they are described as more or less snakes in suits, and they are more important than so, because without any wise investors allocating the capital, the entrepreneur wouldn't have any companies to run. And I think we're taking good investors as granted. They are more important than so, and I don't think they get the credit for this work.
Many good reasons for writing the book. But how was your thought process when you chose these 99 best investors, and why 99?
Well, the working name in the beginning was 100, but the publisher thought that 99 was more marketing
I thought you wanted to be the last one.
No, thank you, but I do not deserve that yet. Well, I try to avoid just luck. So I set the hurdle at 25 years in the saddle for being an investor, and I try to also only get documented performance to rely on. And it doesn't matter if it was in commodities or stocks or bonds or options or whatever. And I think the only way to rank all investors is the number of years and the number of and the performance. So that was the setup.
And Magnus, I just have a comment. We spoke with Richard Lawrence from Overlook, who wrote the book The Model, and you spoke about Peter Lynch and that the average investor in the fund that didn't go well for them, and Richard Lawrence speaks about this concept of time-weighted return and capital-weighted return, and he actually focused on what the investors ultimately get. And was that the part of the work that you did when you evaluated these managers?
No, I only looked at the performance, and it was relative to the benchmark. So all in all, the investors in the book, they have on average 25 years, and they did some 12 percentage points yearly above benchmark. So it's an amazing figure.
Yeah, definitely.
12 percentage points in 25 years.
But how did you measure the benchmark? It's different for every investor, I guess.
Yeah, it was different for every investor. If you manage a long fund in US, I took the S&P 500, and it was a bond investor, I must check the bond, the index, etc.
And how many of these 99 investors did you talk to, and did you get access to them?
Roughly a third I met personal, 1/3 by phone, and 1/3 by email, roughly. Very nice people, I must say. I mean, you could maybe have the picture that they are rude, etc. Very nice overall.
Yeah, were there some investors that you didn't get hold of that you wanted to have in the book or so?
I have 5 investors. I was hunting them in several months, but they would like to live in the shadow. So I had to respect it, and I didn't have any documentation of the performance. I have to drop them, unfortunately.
Well, 99 out of 105, that's really good, I must say.
It took 3 years. So if you come up with a suggestion to write a book, you give me a call, and I will talk you down.
And I mean, you were already before writing the book a seasoned investor yourself, and you said you had managed the fund for 11 years or so. Can you describe a few of the investors in the book that has influenced you the most as an investor?
Well, I have 3 guys which I have a little closer to my heart. It's Ralph Wanger, is an American investor focused on small caps mainly. Glenn Greenberg is mainly due to the fact that he's very concentrated in his portfolio. And John Neff, also an American, a contrarian value investor, managed a fund, Vanguard in US, 31 years. 22 years of those he beat the market. Hard-working guy. And those 3, they work very similar to my rhythm, and that I think is the most important rule for investors to stick to your rhythm. We have different profile. I mean, you maybe are long-term investors and some are traders and some like risks and some not, etc. And it's the easiest way to lose money is to go away from your personal profile. So these three guys, they talk to me.
Yeah, again with Richard Lawrence, he spoke about reading these type of books where you get inspiration, read about other investors, and he said, I always find one or two cousins in those books and in those magazines or so on.
I can agree.
And as you mentioned, these successful investors, they have very different approaches, and you may resonate with some of them, but from studying all of these, are there any common denominators?
Well, here you're touching about the big takeaway in the book, because I thought when I started this work that I would find one outperforming strategy, but in fact I got 99 different strategies, and they are so different. I mean, some of them are buying stocks which recently have made the all-time high, and some of them buying stocks at the bottom. Some of them have 100 stocks and some just 3/4. Some have turnover of 200% in the portfolio and someone just 1% yearly, but made very good performance, all of them, despite so different strategies. And that's the big takeaway. It's not one way. It's so many ways you can manage your money. And despite this difference, it's more similarities between them than you could think. And I have in the book find 12 common similarities between all these investors, and I can, if we have time, take 3 of them, which is my favorites. And one is that everyone has carved out the strengths they have as investors. It could be oil future, it could be retail stocks or whatever, but they stick to this little area instead of spreading around. That's the common sense for everyone in the book. So know your strengths and weakness. The other thing I will bring up to the table is the risk. I thought that doing all this fantastic performance, you must it must have been on behalf of high risk, but it's the opposite. They're taking smaller risk than the average investor. They're looking on the risk on the downside instead of the potential. So if a stock could have 100% risk downside, but 1000% upside, they are not there. But 5% down and 30% upside, that's fine. So the risk surprised me, definitely. And the third I would mention is the flexibility. I thought that these guys, they are digging down to strategy and then they stay there, whatever happens. But that's not true. They are changing. And that's natural because the market is evolving all the time and they follow this as well. So it's the same methodology, but it's another criteria when picking stocks. So it's like the Darwinism. It's not the strongest. It's the more adaptable who win the games. I mean, you could take Warren Buffett, for example. He started as a value investor and then became a quality investor, and now he's investing in Apple, for example. So that was a big surprise.
Yeah, that was something that I also thought about when I read the book, that many investors are talking about change. And there was one good quote by Ken Fisher saying that whatever you do today, it won't work in 10 years. So you really have to evolve. And I think it also relates to independent thinking that, for example, John Rogers was highlighting in the book.
Yeah.
But at the same time, my view is that they still have a few like fundamental principles that they keep. So, I mean, they may change the style, but not the principle. Maybe do you have something to add?
No, I mean, it's correct. It's correct.
The hard part is to figure out how much to change and what to change.
Yeah, and when.
Yeah, and when. And a follow-up question also, because now you mentioned risk as something that they were taking lower risk than you kind of thought they would be. But is there something else that most or all of them avoid doing?
Well, they never invest in something they don't understand. I asked them, when I'm going through all the advice they gave, most frequent answer, never invest in what you don't know. And also, I would like to mention, don't listen to advice from others. Stick to your principle. Do the homework, because if you not have done the homework by yourself, you do not have the stamina to stay in the position when it's blowing around.
And we might be in such a time right now.
Yeah, I guess so.
And in the book, you make an effort to actually rank the top 5 greatest investors of all time. And the list is quite a surprise, at least to me. So can you tell our listeners a bit about this list?
Yeah, it was a surprise because around half of the investors in the book, they are value investors, and I think that if you have worked very long time in the market, it's you get tired if you are a trader. So value investors with lower turnover in the stocks, etc., in the portfolio, they survive longer time. But top 5, 3 of the guys are traders, and that surprised me a bit. They never talked to company. It was in stocks mainly. Never talked to analysts or companies, just sitting and making trades. So that was a bit surprise. We also have a Swede in the top 5. Laszlo Sombatfalvi. He made 30% yearly in 46 years. Amazing track record.
And it was not a home bias there?
No.
Because it was quite different between the market climate they were operating in and the competition they were facing, and also which starting capital they had. So it must have been hard to rank them, I guess.
Yeah, but the ranking is pure number of years and performance. So as you said, maybe it was easier in the past compared with the present situation. It could be. But you also, at present, you have, I mean, half of the market in US, that's index. And it's like you and me playing football with the other team has no ice. I mean, it's easier to make profit in that environment. You didn't have that kind of competition in the 30s, 50s, or 60s. So you could argue for it's maybe easier now than before also.
Maybe we can hone into that subject a bit more, because I think that's a common phrase we hear these days, that because of the rise of the index funds, then it creates opportunities. So why? Can you just explain why does it create opportunities for stock pickers?
Well, the number of active investors getting fewer and fewer. As we said before, the index funds now account for roughly 50% of the market, and I saw some figures the other day that in terms of turnover in the market, they account for roughly 90%. So that's our competition as a active portfolio manager. So I should really make better performance now than in the past when we didn't have these index managers around. So, and if you look at the statistics, it has all the last decades. It has been a difference between the active portfolio managers, funds, and the index. But this gap has closed, and I guess that in a couple of years we will have the opposite, that the active portfolio manager outperforming the index. That's my future guess.
Yeah, so as a private investor managing quite a tiny portfolio still, it's quite interesting to see these events when a company is moving up the to another list, to a larger list, and then the index fund starts to buy. And I think it's just quite surprising sometimes that the date before, and then like the days before, the company could trade up like 20% just because the index fund. I don't know how much is people like going in front of the index funds and actually, push it up that way, or if it's the index funds themselves. But it's just something that I've seen from time and time again.
It's insane.
Quite interesting.
Yeah, definitely. But it's helpful if you could ride this psychology. You could earn a lot of money.
Yeah, as long as you're not leveraged and you can use those short-term opportunities that arise. Then definitely. As long as the right value comes out in the end. If there is only index funds, almost only index funds, then there is a risk that they will just take over the market. And even if you know that what you own, has very, very low multiples and so on, at some point you have to get paid for that. But
if you have time on your side, I would love to be in that market, to be the only active portfolio manager with all the index funds. Yes.
So now we are curious to hear how you are working as an investor and with the fund you have now.
Well, I'm in the value investment corner, definitely. I prefer small and mid-cap stocks, not covered by analysts and the big investment banks. You still have you could have an advantage in knowledge, cover them. Due to the fact that they are a little smaller, they don't fit into the size for the big funds, so they are a little under the radar, and when they growing, they sooner or later coming up, so you have a multiple expansion as well. So I'm in that area. The hedge fund I'm running, it's a neutral hedge fund. So on the long side, it's mainly those stocks I mentioned.
Is it in the Nordics or in which regions are you?
Mainly in the Nordics. We have 50% in the Nordic, and then the rest in Europe and US, and mainly due to the fact that I cannot get the exposure I would like. So then I have to go outside Nordic. But I would like to have a strong balance sheet. They must have structural growth. I also like to have structural market, and with that I mean that they could have a few competitors only, but preferably many clients. That's the perfect setup. I would like to have a strong, a good owner. It could be a bad CIO because he could be replaced if the owner is good, but the owner cannot be replaced. So he's more crucial. And I don't want to have some issues with the technical disruption, etc. That's my long side, and the short side, it's it's sectors where you have problem with technical coming disruptions. So it could be cars, it could be the financial sector, it could be hotels, etc. So that's roughly the setup.
And when did you start the fund?
4 years ago.
Can you say anything about the performance so far?
It was a little bumpy road in the beginning. Last year it was 10% up, and this year we're around 0. We should give some 6 to 7% yearly. When the market is up 30-40%, no one interested in our fund, but hopefully now some will knock on the door.
You run a real hedge fund, so to speak. I mean, sometimes a hedge fund, the name of a hedge fund is used also for those long-only funds. But how has it been managing a hedge fund as of late? I heard that some of them have been struggling for the last decade or so, but maybe you can give some color on that.
I mean, if we take the average hedge fund, they are long some 70%, and that means they are not performing as good as the market when the market goes up, but they are negative when the market goes down as well, and have quite high fees. So you could question the reason for having investments in a hedge fund. But I have sympathy for hedge funds which use the whole possibility. I mean, if you leverage some 400-500% and go all in and have a very volatile market, that's fine. And I think neutral hedge funds also has a reason to exist. But the middle hedge fund, the average hedge fund, it's a question, definitely.
And I must ask you about the experience you had managing the. From what I read, it was a TMT hedge fund from the early 2000s. Yeah. How was that like?
It was a bumpy road. The problem with in this environment was that, I mean, this stock market, we could look at the tech burst 20 years ago and understand roughly what's going to happen. At that time, we was a little unsure how this will play out. So it took a while until everything was settled. And the big difference, I think, now compared with the millennium burst is that the quality of the startup companies I've digged into, they seems to be a little better than it was at the tech burst, because most of the companies at that time, they rely on broadband would be built out in the short term, but it didn't came until 10 years later. So that was a bad analyst work for most of the investors at that time. So better quality now than before. Otherwise, it's very big similarities between these two stock market periods.
I guess the problem with, I mean, you launched it, I think, in March 2000, and so you missed this whole bull run.
Yeah.
And you came in when it's more or less when the bubble burst, yeah. Right?
That's correct. So we were running in negative territory for, but that was fine. I mean, it was quite neutral hedge fund as well. So we managed it okay. It could have been better, of course, but we were still alive after these 3 years. and I've learned a lot, definitely.
I have a follow-up question there. Something that I read in the book, a quote from James O'Shaughnessy, because he's talking about 4 ingredients that investors are facing. It's fear, greed, hope, and ignorance. And that he says that ignorance is the only one that is not being an emotion, and that the only way to succeed as an investor is to learn how to handle your emotional reactions. So how have you been dealing with that aspect of investing?
Well, I have also read this book from Daniel Kahneman, Think Slow and Fast. And there he elaborates about investors, how they should react and how they should manage the money. And as the same conclusion as you mentioned, I mean, you must have a principle and method, otherwise you are smoked in the market. But also after working many years, your experience somewhere you have this experience in your body. So sometimes you could feel that I should maybe sell this, or I should maybe buy this, and sometimes I rely on this feeling, and well, sometimes it's definitely the right signal.
Yeah, we have discussed that the part of intuition, and it's of course pattern recognition as well, when you have been in the market for such a long time.
And the interesting is that most of the investors in the book, they are getting better by age. I think 25% of the investors, they were still up and running at 75 years old. That's amazing. So it's a marathon. You're getting better when you get older. It's a fantastic work. It's better to manage money than to play Sudoku or making crosswords.
I thought a lot about that, and maybe it's because, I mean, if you're really passionate about something, then you don't want it to end.
Yeah.
And I just want to ask also, I mean, coming from Redeye, I'm an equity analyst myself, and you were a top-ranked sell-side analyst before taking over the hedge fund. And I want to ask you, what defines a good sell-side analyst?
To be an analyst is a totally different ball game than being an investor. You must have knowledge about the figures, the product, the market, the competitors, the management, etc. That's basic for everyone. But then the big difference is the storytelling and making business in your covered names, because that's the way you get awarded from the company, and that's totally different from being an investor. As an investor, you have to have the right positions. Otherwise, you are smoked. So analysts, they are storytelling. It's a marketing position. That's a very important side of the work.
And thinking about that, how do you use? Because I mean, you said something there that, I mean, sell-side analysts, as myself, I mean, a lot of it is actually describing how the company makes money, what the competitive situation is, and so on. So, would you say that, I mean, reading about those kind of things are more important from an investor's perspective than actually looking at the base case value or something like that? I mean, how would you use sell-side analysts for yourself?
I use them very little. I'm doing my own work, in fact. Then I'm reading what the reports, etc. And sometimes I realize that if they continue to tell this story, I guess that other investors will join, etc. And I have to shut down my short position or something like that. So that's a part of the game. But I do in my own work nowadays.
And then we have to talk a little bit about books. In the intro, you write that 30 of these 99 investors have written their own books, and maybe a few more books have come out since the book was published. But can you mention a few of these books that are your favorites?
Well, I've read most of the books, and they are good. Many of them. What popping up in my mind is Peter Lynch, One Up on Wall Street. It's a very easy reading book, but full of wisdoms. I love it. And another book I also recommend is John Neff. I mentioned him before. He has written a book called On Investments. I mean, it's a lot of good advice and hard working. So I like that book.
And are you going to write another book, or are you just going to do the hedge fund until you're 150 or something?
To write a book is very time consuming, and the economic benefits, it's not imperative with the effort. That's the way it is. But if I would like to write a book and challenge the hypothesis of the market efficiency, because that's a strange theory. It's still around, and saying that Warren Buffett has in 60 years he outperformed the market by 10 percentage points every year. It cannot be pure luck. That's weird. So if I going to write another book, that's in that theme, definitely.
Last question I would like to ask is how do you split your time between reading, writing, and actually doing homework on investments? And what do you recommend there? Because I mean, we have discussed this a lot, me and Eddie, and we have an episode where we discuss that. And I think some people are in the corner where they almost only read books and don't read any 10Ks, and some do 100% 10Ks more or less, and no reading about books and actually trying to improve your philosophy and so on. Do you have any advice there from your long career and how that has evolved, the split between reading books and reading 10Ks or industry reports or so on?
Oh, I think once again, it's individual preferences. I try to split it between all those three areas. I investing a lot in retail, so I prefer to spend at least one day a week going around in the stores and checking Google Trends and what's happening there. And for other investors, they get more from 10K, etc. So I'm difficult to give any recommendation here.
I guess it's the same as everything. I mean, it's all subjective, but sometimes it feels like you can just put a number on something, and that's how it is. I feel that sometimes with reading like financial media, where someone writes that now you should go in and buy, now you should go in and sell, and everything is on different time horizon. You can have a time horizon that is investing for 10 years, and someone else may invest for the same day, and so on. And it just feels like everybody tries to put everyone in the same bucket, but we're all different and we have all different perspectives.
Yeah. That's the way it is. Yeah.
So Magnus, thank you so much for a really insightful conversation about you and the 99 greatest investors. Do you have something more you want to add before we finish up?
Maybe. I'm a little bit regarding the book. This year it will be published in South Korea and in China, and without any changes in the book. I'm just wrote a new preface. otherwise, it seems like the conclusions and advice are timeless. So they are happy with the 9-year-old book. So I'm a little bit happy for that.
Oh, really interesting.
Yeah.
I think we have some South Korean listeners to the podcast. It will be interesting if we get some feedback there.
Yeah, that would be great.
Where can our audience follow you and find the book?
If I understand correct from the publisher, the stock is very small at present, so you must hurry up if you would like to have a copy of it. But it's I think on Amazon you could buy it still as an ebook, for example.
And for those who are interested in following your fund and so on, is there any can they invest, and is there some material out there?
Yeah, definitely. They are more than welcome. We are. You could invest through NodeNet, for example. So we are open, and the minimal is 10,000 kronor, so it's peanuts. They're more than welcome.
Perfect. Thank you so much.
Thank you so much for having me.
Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at @IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.